Should you own gold in your asset allocation retirement portfolio? To answer that question, we're going to take a look at the long-term price history for gold, some of the past bear markets for gold, which I think will be really surprising to some of you. And then we're going to look at the quantified diversification benefit for gold, i.e. the correlation coefficient, the degree to which gold is correlated to the S&P 500, for example, real estate, and other common asset classes. Here's the long-term price graph on gold in US dollars. We're looking at nearly 50 years, and it's very clear that for someone who's held for the last 4+ decades, they've definitely made money on gold, especially in recent years. But what I want to draw your attention to is that gold can have serious bear markets, and they can last for a long time. If your timing was bad with gold and you bought here in the early 80s, 20+ years later, you are still down 50% on your gold investment. That's a long time to lose money. And unlike indexes like the S&P 500 or the Russell, you don't receive any dividend from gold. There's nothing in the form of income while you're holding it. The duration of the bear markets for gold have been very long in nature, longer than the stock market. If you had bought in the early 80s, bad timing, it took you almost 30 years to break even. And then if you had bought again at the high water mark in 2011, you didn't break even until about 2023. That's when we really started to move up here. So these are two long-term bear markets for gold, meaning that you can have time periods where you have no return and get no income for a long time. Also, the drop from here in 2011 to the bottom in 2015 was about 40+%. So gold can lose a lot of money when it enters a bear market. Whether or not gold can protect you during a recession is inconclusive in my opinion. I have recessions shaded as gray bands on this chart. You could see 2008 gold dropped. Not a lot of movement here in the early 2000s. It went sideways in 91. Dropped here in the early 80s. In both recessions, gold went down. So my opinion on gold in a recession is that you just don't know what's going to happen. It could go up, down, or sideways. Really no way to tell what kind of diversification benefit you'll get if we enter a recession and you own gold. Ultimately, you are going to get some inflation protection, and it is a store of value, but I think your time horizon on gold needs to be really long-term. That's the big takeaway from this price graph. When you can lose money for 30 years, you need to have a long-term time horizon when you own an investment. I would add that the times that we're in right now are very unique. We are so leveraged as a society. We have $100 trillion of total debt in our society. The government debt, over $36 trillion, completely out of control relative to GDP. We're running $2 trillion deficits. There's a lot of reasons that gold may go higher in the years to come, just because of the debt alone. Now, if the debt crisis is solved, gold may come down in value. But if this debt crisis continues, there may be more room to run for gold. Here's the 10-year correlation table for gold using GLD ETF as a proxy against other standard asset classes, like the S&P 500, where we're using SPY ETF as a proxy, or GSG ETF, Commodity Index, SHV, short-term treasuries, iShares US Real Estate ETF, IYR. How you interpret this correlation coefficient table is you just look at the intersection of the numbers, and that will tell you the degree to which two investments are correlated. This is from 12/31/14 to 12/31/2024. Long-term picture, 10 years. So gold is number 5. So we see that 5 and 1, that's GSG Commodities Index, are minus 0.02. Virtually no correlation there, to be expected. 0.08 with the SPY ETF. This is great diversification benefit when you compare gold to the S&P 500 over the last decade. Almost no correlation, which means it's a great diversification asset. 0.43 to number 3, which is iShares US Aggregate Bond ETF, i.e. the whole bond market. So there's a fair degree of correlation between 5 and 3, which is gold and bonds. at least the entire bond market. But if we look at 5 and 4, which is short-term bonds, it's only 0.22. And then 5 and 6, which is real estate, using the IYR ETF, 0.21, fairly low degree of correlation. So when you think of gold in a portfolio context, what I see here is a good diversification benefit. If you have questions about your investments, please give my office a call. We would be happy to give you a second opinion on your portfolio. If you like this content, please share it with your friends. I hope this video was helpful. I hope it gets you thinking, helps you better analyze your investments, and overall improve your family's financial plan.